Welcome to the Deep Dive. We're plunging into the past today, looking for wisdom that, well, really shines a light on the present. And today we're tackling a pretty pivotal moment, a year that felt calm to many, but looking back, it was humming with challenges just beneath the surface. Okay, let's unpack this. Our focus for this deep dive is the Markel Group Shareholder Letter from 2007. We've got the detailed annual report you provided, that letter to business partners, and some really great guiding questions. Our mission: to cut through the usual corporate speak, find the real nuggets of wisdom, and understand how a company like Markel navigated 2007. A year right before the global financial crisis really took hold. We'll look at their mix of insurance and investing, their management style, and what it all means for you trying to build long-term value.
It really is fascinating because 2007 on the surface seemed fine for many. Markets looked strong. But this letter, it subtly hints at these profound shifts, these challenges already brewing. Markel's view, especially knowing what came next, it's incredibly insightful, almost prophetic, really, in its discipline.
Yeah, and what just leaps off the page right away is their reported success that year. They announced a net income of $406 million, and get this, their book value per share grew an impressive 15% in just that year, hitting $265.26. Over 5 years, that compounded at 18% annually. I mean, those are serious numbers, especially when the market was getting shaky.
Oh.
So how did they pull that off when so many others were about to stumble?
Well, if you connect those numbers to the bigger picture, it's not just random good luck. It's really proof of their stated strategy, maintaining discipline, unwavering discipline. They even said it directly. They were sticking to it even as the market got more competitive and undisciplined, as they put it, holding back when everyone else is chasing growth. That paid off. It's often the hardest thing to do, right? Resist the herd. But Markel shows that this kind of counter-cyclical thinking, it builds resilience, especially on the edge of a major storm like the one brewing then.
Right. And the letter points to a few specific, almost low-key factors for that success. They mention a quiet year on the weather front, always helpful for insurers, but also their underwriters sticking to their guns, and maybe most crucially, avoiding most of the landmines starting to show up in the financial markets. What kind of landmines are we talking about here? How do they sidestep them?
Well, 2007 was when the subprime mess really started to unravel, wasn't it? Lots of big institutions were loaded up with complex mortgage-backed securities that were, frankly, becoming toxic. Markel avoided that partly because of their investment philosophy, we'll get into that, but also because they were disciplined on the insurance side. They just refused to write unprofitable business.
Okay, but it wasn't all smooth sailing. Even with strong financials, the letter talks about the property and casualty insurance market getting tougher. A softening market, they called it. What was making it so tough? And how did Markel handle that?
Yeah, that's a crucial point. It really raises the question, how do you thrive when the industry is flooded with capital and competition is fierce? The dynamics they described were pretty stark. Increased competition, sure. Some property guys were pricing risks at what we believe are unrealistic levels.
Right.
Why? Because there hadn't been major weather events recently, so people got complacent, maybe a bit greedy. And the industry was just swimming in capital. About $540 billion in the U.S. P&C market against only $450 billion in annual premiums. That meant the underwriting leverage ratio was the lowest since the last soft market. Now, for you listening, leverage ratio basically shows how much risk an insurer takes relative to its capital. A low ratio here meant too much money chasing too few good deals. It created this aggressive pricing environment, and that's not even counting offshore capital from Bermuda, London. More competition.
Wow. So their response was very deliberate then, almost. Going against the grain. They chose caution, not growth. Their gross written premiums actually dropped 7% from 2006 down to $2.4 billion. And they said it plainly. We would prefer to grow. However, our focus has always been and will continue to be producing profitable underwriting margins. That's a powerful statement of priorities. So pulling back when others chased volume, how did that protect them and maybe even position them better for the storm?
It's all about the long game, isn't it? Short-term gains versus long-term health. By writing less business, Markel avoided those unprofitable, risky policies. It might look bad for growth numbers temporarily, but it kept their book of business clean. That discipline meant they weren't carrying the hidden risks that come with underpriced policies, and that's vital when financial markets start to seize up. It wasn't just defense, it was about preserving strength for what was coming.
And the result of that discipline, still strong underwriting profits, $264 million, with an 88% combined ratio, which, just to remind everyone, below 100% means profit just from insurance, before investments. 88% is fantastic, especially then. Looking closer at their operations, they had some real wins in their specialized units too.
Markel International, MINT, actually reported underwriting profits for the first time. A big step. They even paid a dividend back to the parent company. And domestically, Markel Shand and Markel Essex, their specialty units, kept churning out profits. Shows the strength of their core underwriting.
But what's really telling, even with those wins, the letter is honest about the disappointments. Yeah, overall premium volume was down, margins were good, but they admitted they'd slipped a bit. But the big one was Markel Re's issue with that smart product line, specialized Markel alternative risk transfer. This was them trying out complex, non-traditional insurance. A bit of a detour for them. And it backfired. Why? Delegation of underwriting authority, without, in hindsight, sufficient underwriting oversight. They flat out said they relearned an expensive lesson. What's amazing is how fast they reacted. Admitted the mistake, made a plan to shift the good bits elsewhere, and wind down the problem areas for 2008. That willingness to say we messed up and fix it, that's critical for long-term survival. Speaks volumes about their culture, profit over ego.
That transparency really is key. Being so open about the smart failure in a shareholder letter, that's pretty unusual, isn't it? What does it say about their culture?
It signals deep accountability, a real long-term view. By owning the mistake, they reinforce trust with shareholders, and internally too. It shows they value learning over just looking perfect, and that ultimately makes the organization stronger, more adaptable. It's a powerful lesson in corporate honesty, really.
Okay, so shifting gears from underwriting, their investment side was just as crucial, especially as markets got, well, chaotic.
Yeah.
The letter calls 2007 one of the most challenging investment markets in recent memory, yet they steered clear of most of the problems. How?
Indeed. Despite all that chaos, their total investment return was a solid 4.8%. Fixed income did well, 5.6%. Equities had a small loss, 0.4%. But the really striking thing is their fixed income approach. They called it plain vanilla. Just investing policyholder funds in high-quality stuff, minimal credit risk. They explicitly said the stubborn insistence on basic and uncomplicated credit quality let them avoid the debacle faced by many larger and more sophisticated investors.
Nice.
It reminds you of that Will Rogers quote, right? I'm more concerned about the return of my money than the return on my money. Markel clearly lived by that. Safety first, especially in '07.
And equities. They stuck to their knitting there, too. That clear four-part philosophy, good returns on capital, honest management, reinvestment, smarts, fair price. Yeah, that 0.4% loss in '07 wasn't ideal, but they pointed to the long view, 5 years, 11.8% returns, 10 years, 10.7%. That, they felt, was the better representation.
Exactly. And this brings us to maybe the most crucial part of their philosophy, the belief that this time is not different. They acknowledged their '07 equity performance was hit, partly because they held financials and consumer stocks, not the hot energy and commodities, but they pushed back hard against the market hype. Quoted John Templeton, "The 5 most expensive words in investing are, this time it is different." Markel just didn't buy that energy prices would stay sky high forever or that financials would stay depressed forever. Their view, technology tends to make basic materials cheaper over time. So they favored intellectual and financial capital, things like brands, patents, financial services, over just physically based substances. Their portfolio was, as they put it, stuffed with companies having that intangible edge. And they had this deep faith in the financial system's ability to heal. They expected normalcy will return once the irresponsible lending practices and unwise securities market behaviors gets digested. They looked back at history, the S&L crisis, 1974, 1929, even the 1870s, as proof that cycles happen, corrections happen, but fundamental value wins out. And they quoted Herbert Stein, too. Things that must happen, Will, including fixing the financial system. They were also really bullish on America, pushing back against the naysayers, pointed to a low dollar helping exports, foreign investment, basically saying skepticism about the future of America is misplaced.
It's fascinating. So much conviction against the tide. And it feels like this conviction comes from something deeper than just numbers. It links back to their core values, what they call the Markel style.
It absolutely does. That Markel style isn't just window dressing. It seems fundamental. It lays out the principles. Commitment to success, honesty, fairness, responsibility to everyone, customers, suppliers, employees, communities, shareholders, always looking for the win-win. And they connect it directly to governance, saying good corporate governance is about these same principles. It's all about finding the best alignment of the interest among all stakeholders.
Right.
They even happily admit they copied Berkshire Hathaway's owners-related business principles. They really see shareholders as partners. It's very intentional.
And you see that partnership idea clearly in how they pay their managers. It's pretty different. Competitive-based pay, good benefits, sure. But the big bonuses, only after hitting superior returns. And a lot of it is through owning stock.
Their bonus plan is super simple too, based purely on the 5-year compound growth in book value per share. That single number captures underwriting and investing. Long-term focus. They even share that 2005 example where hurricanes hit profits and executive bonuses took a hit too. Real accountability baked in.
Which raises that important question. How do they really get that ownership mindset ingrained beyond just bonuses? Well, Markel is pretty blunt. They disagree with stock options. They think purchasing, paying for, and assuming the downside risk are all integral components of stock ownership. You need skin in the game. So senior managers are actually expected to own Markel stock a multiple of their salary, and they help make it happen. Part of the retirement plan contribution is in Markel stock. They have payroll deduction plans, even low-interest loans for buying stock. Plus, a substantial portion of top executive bonuses are paid in restricted stock, not just cash. The result, by the end of 2007, their own associates owned over 10% of the company. Just under $500 million worth. That's serious alignment. Everyone's rowing in the same direction.
And it all links back to that transparency and objective evaluation. They talk about consistent and conservative accounting policies and full disclosure so shareholders can judge for themselves, like their policy on loss reserves. We consistently seek to establish reserves that are more likely redundant than deficient. Basically, they'd rather set aside too much than too little. That signals stability, responsibility. So even in a strong year like 2007, they weren't resting on their laurels. They were clearly looking ahead, planning for the future. They like that move to consolidate branding. Changing subsidiary names, Shand Moorhan became Markel Shand, Essex became Markel Essex. A smart, simple move to better capitalize on the strength of the Markel brand. Makes sense. Unified identity.
Exactly. And what's really fascinating is how proactive they were. Like with that 2008 initiative they called Atlas. The goal was to create a map for Markel's future operations, basically taking a hard look at all their processes, figuring out how to adapt to new tech, market changes. They admitted nothing operationally is broken, but they still saw the need to constantly adapt, to improve, even if it meant spending money and time on this project. That's a huge lesson, isn't it? True innovation isn't just fixing problems. It's about constantly questioning, refining, even when things seem fine. That's how you build lasting health, not just react to crises.
Absolutely. And even though they expected 2008 to be tough, market-wise, they sounded optimistic, confident they'd find opportunities to underwrite well, invest well, and keep building value. It's that resilience, that forward look grounded in their philosophy that really stands out.
Definitely. So if we boil it down, the core lessons from Markel's 2007 letter seem crystal clear. Unwavering discipline in underwriting. A long-term, value-based investment view anchored in this time is not different. And this powerful culture of partnership with shareholders built on transparency and aligned interests. And these weren't just words on paper. You see it in their actions, how they handled mistakes, their consistent results, especially when you know the '08 crisis was just around the corner.
So for you, listening to this, think about Markel's principles, that return on my money focus, that deep belief that this time is not different even when markets are wild. How much of your own strategy, financial or otherwise, is really built on those kinds of time-tested ideas? And where might you, maybe without realizing it, be acting like things are fundamentally different today? It's definitely worth reflecting on how Markel's long-term view, their discipline, their willingness to buck the trend, how that might shape your own decisions in business, investing, or just navigating whatever challenges come next.